You can buy fire insurance on a house you do not own, not your house, your neighbor's house, and if it burns down, you collect the money even though you lost nothing, even though you were never going to. That sounds illegal. In most of the world, for actual houses, it is. But for one specific kind of contract, it is not only legal, it is a market worth trillions of dollars. And in 2008, it nearly took the whole thing down. So what actually is a credit default swap? Start with something ordinary. You lend a friend £100. There is a chance you never see it again. Now imagine a stranger offers you a deal. Pay me £2 a year, they say, and if your friend ever stops paying, I will cover the whole 100. You have just bought insurance on a loan. That is the entire idea. A credit default swap is insurance against someone failing to pay back a debt. Here is the vocabulary, and then we can throw most of it away. The thing being insured is usually a bond. A bond is just a loan you can buy. You hand a company money. They promise to pay it back with interest. The buyer of the swap pays a small regular fee. The seller collects that fee year after year and quietly hopes nothing goes wrong. If the borrower defaults, the seller pays out. It really is just insurance. The word swap makes it sound clever. It is not. The contract was built by a team at JP Morgan in the mid-1990s. The often told origin story is from around 1994. The bank had lent a huge line of credit to Exxon, was nervous about the risk sitting on its books, and wanted a way to be paid to make that risk someone else's problem. So they invented one. For a decade, it did something genuinely useful. Banks could lend more freely because they could offload the danger of not being paid back. Now the first complication. Real insurance has a rule. To insure a house, you have to own the house. You need what is called an insurable interest. This stops you profiting from a disaster that costs you nothing. Credit default swaps have no such rule. You can buy a swap on a bond you do not own, which means you are no longer protecting yourself. You are simply betting that a stranger's debt will go bad. And if it does, you win. So the market stopped being about safety. It became about wagering. And because it was just a private contract between two parties, anyone could keep writing more. A single risky mortgage bond might have many times its own value in swaps riding on it. By 2007, the total stack of these contracts had grown to something like $60 trillion, larger than the economy of the entire planet. Which brings us to the second complication, and the one that broke everything. When you sell fire insurance, the regulator makes you keep money in reserve in case the house actually burns. The people selling credit default swaps largely did not. One company in particular, the American insurance giant AIG, sold enormous amounts of protection on bonds tied to American home loans. They collected the fees. They set almost nothing aside. They were, in effect, promising to cover a fire while keeping no water. Then the houses burned. When American mortgages began to fail in 2007 and 2008, the bonds built from them went bad all at once. Everyone who had bought protection came to collect. AIG owed more than it could possibly pay. And because banks all over the world were holding AIG's promises as if they were solid, the failure of one insurer threatened to pull down everyone connected to it. In September 2008, the United States government stepped in and rescued AIG with around $180 billion of public money. Not to save AIG, to stop the promises from failing everywhere at once. So look back at the neighbor's house. A credit default swap is a promise to pay if something you do not own falls apart. Useful when it is genuine insurance, dangerous when it becomes a bet, and catastrophic when the people making the promise never kept enough money to keep it. It was never really about mortgages. It was about a contract that let millions of people insure the same burning house, and one company that agreed to pay for all of it and had nothing in the bank. Now you know.